Provocative title, don't you think so? We will not engage in stock picking, market timing, and active strategies, where the result will mostly depend on luck. Today, we're diving deep into how you can maximize your returns by understanding key metrics, like TER and TCO. We'll break down these terms, show you how to calculate them, and reveal how they can make a significant difference in your investment outcomes. Welcome back to Penny Street Journal. We consider a passive investor who builds a portfolio based on ETFs. In his arsenal, the investor can at least use the following tricks: minimize the tax burden, minimize transaction and commission costs, minimize exchange rate losses. You can see what ETF is and how it works in our video. TER, total expense ratio, fund management commission. Every year, the total TER for all funds is gradually falling, which is nice. However, TER is not something to pray for because it is not representative. Analysts and portfolio managers use a combined indicator, TCO, total cost of ownership. Let's break it down into parts. TCO, equal sign tracking difference plus bid-ask spread plus brokerage fee. We will leave the spread and commissions of the broker for another video. The target today is TD, tracking difference. 2 theses. The index is just a mathematical indicator, a formula. You cannot invest in the index. It's like the North Star. You can't touch it, but the route shows. The index ETF follows its benchmark, index, by copying its structure already from real assets. You can invest in ETFs. It's basically a game of catch-up. All changes first take place in the index, and only then the fund provider makes appropriate manipulations in its portfolio. And often, the result of the ETF fund differs from the result of the index, because the ETF provider has additional service costs plus a time lag in decision-making. This is where the tracking difference indicator comes from: index return. ETF return equals sign tracking difference. If in 1 year the index grew by 10% and the ETF only by 9%, then its tracking difference equals sign 1%. And these are the losses of the investor. Unearned profit. Often this lag behind the index is much larger than the TER, as the fund incurs additional costs that are not included in the TER: rebalancing cost, swap spread, securities lending, hedging cost, replication method. It is rational to look precisely at how accurately your fund tracks the index. Example of ETF on S&P 500 IVV: TER 0.03%. TD minus 0.03%. The fund annually lags behind the index by minus 0.03% CSPX, TER 0.07%, TD 0.22%. The fund annually outperforms the index by 0.22%. If an investor had invested $10,000 each in IVV and CSPX in 2010, he would have had this result. IVV equals sign $48,287, CAGR equals sign 12.53%, CSPX equals sign $63,519, CAGR equals sign 15.07%. Although the CSPX fund is more than twice as expensive as IVV in terms of TER, in our example, the CSPX fund turned out to be more efficient. Note, this rarely happens with UCITS funds. They often lose to American ETFs. Do not repeat this at home. The comparison is purely for example. In addition, I took a fairly simple index, and the more complex the index region world bonds, the more important the difference between TER and TD can be. You can see TD and other transaction costs here and here. Use and select optimal funds. PSS, unlike the constant TER, which is indicated in the provider's ETF on the website, the TD indicator is dynamic and can change every year. When analyzing, look at several years to select funds with a truly representative TD. Otherwise, you will be transferred to competitors' funds every year. That's it for today, folks. Useful? Share with a friend? Remember, the journey to financial freedom is a marathon, not a sprint. See ya in next videos.